देख रहा है विनोद, बिना मांगे ही फॉरेनर्स इंडिया को उधार देना चाहते हैं. Something major is happening in India starting June. Historic. This is the financial market equivalent of the Chandrayaan landing on the dark side of the moon.
Lander module.
Unfortunately, the world of economics and finance often lacks drama. So even as economists, traders, investors have been counting down to the D-Day of 28th June, most of the general public may be blissfully unaware of what just happened. But fear not, that's exactly why this channel exists. Starting June, for the first time in its history, India is going to be part of a major global bond index. What this effectively means is that foreign investors will be queuing up to buy Indian government bonds. Think of this as Apple fans lining up to buy the latest iPhone on the day of its launch. But what is this exactly? Why is this a big deal? And how will this impact the economy? All this and more in this episode of The Bond Economist, your one-stop destination for professional advice on the economy. My name is Arudeep Nandi, and today we talk about India's inclusion in the JPMorgan Government Bond Index of Emerging Markets and why this very boring sounding sentence should actually interest you. As always, if you like what you see, please hit subscribe. And if you'd like to support my work, the super thanks button is below. First things first, what on earth is this bond index inclusion business? An easy way to think about this is that a bond index is conceptually similar to the Nifty or the Sensex. As the name suggests, it is an index that tracks some of the selected bonds. In the case of JPMorgan Emerging Market Bond Index, it is a collection of government bonds of selected emerging markets. Basically, countries that are generally deemed to have strong growth potential along with financial and macro stability. Now, there are a lot of investors internationally who are like, I want to invest in bonds of such emerging markets, but frankly, I don't have the time or expertise to figure out whether I should buy Indian government bonds or Indonesian bonds or Chinese bonds, or if I want to invest in a basket of bonds. And if I do that, then how do I decide how much weight I should give to each country? So a lot of investors passively follow these popular global bond indices. If the bond index now says that we are putting 10% weight on some country, they will do the same. In the case of the JPMorgan index, it represents over $200 billion worth of assets under management. For a long time, JPMorgan didn't add India to its bond index because there were actually a number of operational issues, including demands for tax concessions. And while at some point the Indian government was interested in this bond inclusion, after a point when things were going nowhere, the government was like, look, we are in no mood to change our tax policies for you. Aana hai to aao, nahi to jao. Koi baat nahi. And in evidence of how stable India's macro policies have been, how excited investors are about India's growth outlook, and how after the Russia-Ukraine war and the slowdown in China, investors are craving for diversification, JPMorgan announced last year that starting 28th June this year, despite no concessions given from the government side, India will be allocated 10% weight in their bond index, with 1% being added every month. So other economies will have their weights lowered to make way for India to be part of this index, which means that in the next 10 months, of that $200 billion plus of foreign investors' money that's tracking this index, in theory, 10% of it will come to India, with 1% every month. In practice, the amount could be even higher. Just like there are passive investors, there are also active ones who know that come June, the passive guys will be lining up to buy Indian government bonds, driving up their prices. So some foreign investors had started buying Indian bonds since the announcement. Also, other bond indices may want to join the party. One of the indices run by Bloomberg intends to add India next year. Who knows, others could also follow, which means that at least this year, there will be a massive inflow of foreign investment into Indian bonds. Market estimates put the number anywhere between $30 to $40 billion. How big is this amount? Well, the central government is expected to borrow around 12 trillion rupees this year from the market to basically fund the shortfall of its revenues versus what it intends to spend in a year, basically the fiscal deficit. 12 trillion rupees at the current exchange rate is around $146 billion. So let's say for the ease of calculation, $150 billion. So of this $150 billion that the government is borrowing this year, some $30 billion or 20% of the amount will effectively be paid for by these new foreign investors. So what will the impact of this be on the economy? Well, India, and as a matter of fact, most emerging markets have two major insecurities. Insecurity number one is when the country is importing too much, and insecurity number two is when the government is spending too much. It's called the twin deficit problem. Why twin deficit? Well, the extent to which a country imports more than what it exports and what it gets back as remittances from abroad is broadly defined as the current account deficit. And when the government spends more than what it earns in taxes and from other sources, it's called fiscal deficit. India has had a long history with the twin deficit problem. Governments have been irresponsible in running high fiscal deficits, which means that they have had to borrow more and more from the market every year, adding unsustainably to the national debt and causing interest rates to rise. And in the case of the current account deficit, Indian goods exports have struggled to be competitive, while India keeps importing oil, gold, and a bunch of foreign goods demanded by our industries and the public. In fact, whenever there is a crisis in any emerging market, you'll notice that the twin deficit problem is usually a common theme. In our own backyard, it's been a problem with Pakistan and Sri Lanka. Now, India in the past decade has done a stellar job in controlling both these deficits, and actually credit goes to the Modi government to maintain this fiscal and economic discipline despite the pandemic disruption. It is in fact one of the reasons behind why India is being included in these global bond indices. And the fact that it has been included now in turn will help India better manage these two deficits in the future. Why is this the case? The fiscal deficit side is actually simple. The government is getting a new source of demand for its bonds. More demand for bonds means lower interest rates, which in turn means that the government has to worry lesser about who will fund its market borrowing and how much that borrowing will cost. And why is this good for our current account deficit management? Well, remember, current account deficit is roughly speaking what we import versus what we export and what Indians abroad send back as remittances. So on the one hand, on a net basis, our country is always leaking dollars on the current account. To plug this hole, we rely on dollars from foreign investors who are investing round the clock in India's stock markets, in India's bond markets, or those who are actually setting up operations in India like Hyundai or IKEA or Apple. And that's called FDI, foreign direct investment. Hopefully it is now becoming clear to you why these new foreign investment inflows into the bond market matter to India's external sector. The entirety of India's current account deficit last year was a little over $20 billion. So actually the amount of $30 billion just from foreign investors in the bond market, mind you, in addition to this, there will be flows in the equity markets and FDI. So $30 billion alone could be enough to cover a large share, if not the whole, of a year's worth of dollar leakage from the current account deficit, which is kind of a big deal. It means this year at least, we should have no problem if, say, oil prices were to hypothetically shoot up and our import bill blows up, because just like there will be dollars going out through the current account route, there will be enough dollars coming in through the foreign investment route. And look, at the end of the day, India is a growing economy, and for achieving its potential, it needs money, both the government and the private sector. Be it to upgrade India's logistical infrastructure like roads and ports, or be it to build India's climate change resilience, or for companies to set up manufacturing plants in India. We are a capital hungry country. But the problem is that if domestic banks and financial institutions are forced to, or find it easier to lend to the government by simply buying its ultra safe bonds, as is the case now, a large majority of government bonds are ultimately held by domestic institutions, which then means that there is lesser resources available for the private sector to grow and expand, and they have to pay a higher amount to get their hands on that capital, But now with the government's investor base expanding to include more foreign investors, it means that the public sector has to rely lesser on domestic banks and institutions to fund its fiscal deficit. In the process, freeing up resources for the private sector and hopefully bringing down the cost of their borrowing. So, the bond index inclusion is good for India's fiscal deficit, it is good for India's current account deficit, and it's good for India's growth prospects. But how will all of this impact the rupee? Well, if there is so much amount of foreign money coming into Indian government bonds in 1 year, they will be buying rupees with their dollars. The more demand for rupees, the more it will appreciate. But the RBI will be watching this like a hawk, because the RBI wants to keep the exchange rate as stable as it can. Just as too much depreciation is bad for the economy, as imports become more expensive, too much appreciation means that the rupee becomes too expensive, so Indian exports become more expensive to the outside world, and hence India becomes uncompetitive. So what will the RBI do if it sees foreigners snapping up the rupee and causing it to appreciate too much? Well, it will be inclined to buy those dollars and flood the market with rupees. And this achieves two objectives for the RBI. One, it prevents excessive appreciation of the rupee. And two, RBI's forex reserves go up, which the RBI is also really keen on, because reserves are like a war chest of sorts against any economic crisis. But controlling the exchange rate too much also causes other complications. When the RBI buys all those dollars entering into the economy, it is ultimately selling rupees that will flood the domestic money markets, and liquidity will increase. More liquidity will push down market interest rates. Now, if interest rates fall too much, then in the RBI's mind, there could be the risk that this could add to inflationary pressures, which at this point is tracking close to 5% levels, while RBI's target is 4%. So then the RBI may want to intervene in the domestic money markets to soak up all this excess liquidity. For instance, if it started selling government bonds, then effectively it will be vacuuming out the excess rupees that it injected in the market while buying dollars earlier to control the exchange rate. So the RBI is like the Gandalf of this realm. Chota-mota things are allowed to happen, but when something big is on its way, Gandalf rides in with his staff and says, "You shall not pass," and tries to control the situation. And by the way, if tomorrow there is a crisis in India or among other emerging markets and these foreign investors panic and exit our bond markets and sell off their bonds, the RBI will have to do all of this in reverse. Sudden starts and stops to capital flows is one of the major problems that emerging markets have to contend with. And so this bond index inclusion, despite all its lovely benefits, also means that the RBI will constantly have to remain on its toes. So all that glitters is not always gold. And look, it's not just the RBI that has to be on its toes. It's also the country as a whole. India's inclusion in these global bond indices is yet another signal that the world is seeing our strong growth, our falling inflation, the lower current account and fiscal deficits and stable politics, and saying, yes, we are ready to place more trust in this economy. We want to be part of its growth story. And so it's a bit like surfing. As long as the country is on the top of the wave, it will be fine. But if you lose your balance, if your fiscal deficit goes up by too much beyond control, or inflation picks up too much, or growth falters, or the political situation becomes volatile, then foreign investors may dump Indian bonds, and all the goody-goody things that we are talking about now will reverse. Like what happened to Egypt. It was added to the index in 2022, and then due to its economy underperforming and with its shortage of foreign exchange, it got kicked out of the JPMorgan bond index in 2024. Look, the bottom line is that we are now entering the big leagues. Our economy, our markets, our institutions are maturing, which means that the world is collectively placing more faith on India. Doing things khatakhat is no more an option.
हर साल 1 लाख रुपया 8,500 रुपया महीने का खटाखट 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 आता रहेगा.
Because to quote from the old Spider-Man movie, with great power comes great responsibility. For more such insights, like, share and subscribe to The Bond Economist.